Hi, and welcome to this week's market presentation. Latest news. Starting with the latest news, the US has increased its pressure campaign against European nations as President Trump continues to push for the sale or annexation of Greenland by the United States. Trying to push back against the demands by President Trump, several NATO members have launched Operation Arctic Endurance, deploying active military troops to Greenland in a show of force against the US. Over the past week, in what has been a significant escalation of tensions, President Trump announced that it would be imposing tariffs of 10% on imports from 8 European countries starting February 1st. Those countries include Norway, the UK, France, Germany, the Netherlands, Denmark, Sweden, and Finland. Those tariffs would increase to 25% starting on the 1st of June if a sale or annexation of Greenland has not taken place by then. World markets have reacted with additional uncertainty as the situation develops. US officials are now in Europe in Davos, and they are discussing with their counterparts what the demands from the Trump administration and what possible outcomes can be achieved. Overall, the European Union and European countries, specifically Denmark, remain staunchly opposed to the sale of Greenland or the annexation by the United States, while the US domestically continues to highlight their importance and their desire to have the territory. So far, the impacts on energy markets remains limited, although the prospect of tariffs could add additional pressure on the European and US economies, potentially impacting future demand. Moving towards the Middle East, the Iranian protests have been at times brutally put down by the Iranian government, with reports of over 3,600 people killed and more than 24,000 protesters having been arrested. Tensions remain high following the threats by the Trump administration to move forward with direct military action against the Iranian government in support of the protests that began over a week ago. So far, the US has held off from initiating any military action, but nonetheless, it is moving additional military equipment and personnel into the region, most notably an aircraft carrier strike group moving from the South China Sea towards the Middle East. The impact on energy markets continues to be one of additional volatility and uncertainty, with ongoing concerns that a further escalation and certainly a direct military intervention by the US could threaten the 1.4 million barrels per day of Iranian crude oil exports or the 3.3 million barrels per day of crude oil production out of Iran. Weather. Weather conditions continue to be one of the main market drivers, particularly for natural gas prices in Europe. Over the course of the next 7 to 10 days, temperatures are expected to remain cold across Europe, moving along the seasonal average, particularly through the middle and then beginning of the following week across most of Western Europe. Central and particularly Northern Europe, especially the Nordics, will continue to experience well below average temperatures by as much of 11 degrees below average. The colder weather will continue to put pressure on the decreasing gas storage levels, and as a result could add additional support for natural gas prices, particularly in the shorter term. Precipitation will remain persistent over the next 7 to 10 days, particularly over Western Europe, with more limited precipitation over Northern and Central Europe. Lastly, over in regards to average wind speeds, we are seeing slightly higher wind speeds, particularly along the North Sea, which could provide a boost to wind power generation in Europe following the past week of lower wind output. Macroeconomics. The latest macroeconomic economic indicators came out, including Q3 GDP figures for the US, which showed continued robust performance of the US economy. On an annualized basis, the US economy grew at a rate of 4.4% in the third quarter of the year, surpassing expectations. Over in China, we have the fourth quarter GDP growth figures, which showed a further acceleration of economic growth quarter over quarter to 1.2 percentage points for Q4, with real GDP year over year growth at 4.5% over the last quarter of the year. Nonetheless, taking into account the growth over the entirety of 2025, Chinese officials announced that the Chinese economy reached their 5% growth target last year. In terms of inflation in the euro area remains in line with the target set by the European Central Bank, especially when we look at headline inflation rate, while core inflation remains slightly higher at 2.3% as of the end of last year. In the US, inflation remains steadily above the 2% target set by the Fed, and given the sticky inflation above that target and the robust economic growth the US is seeing, market expectations are for the Federal Reserve to hold off on any additional interest rates in the coming months. Crude oil and LPG. Crude oil prices saw an uptick in the price level over the last week and a half, largely driven by the situation in the Middle East and the concern over Iranian exports. Over the past week, as tensions appear to be simmering with no further escalations as of yet, crude oil prices have remained more stable week over week. Overall, market expectations remain on having an oversupplied market throughout 2026, although these geopolitical tensions and risks could certainly eat into that supply surplus and as a result push prices above current levels. The EIA continues to estimate a supply surplus by as much as 3.5 million barrels per day in the first quarter of the year. Natural gas. Moving towards natural gas, we see the TTF price evolution and the sharp rebound in gas prices in the front quarter, with the second quarter of 2026 up just over 15% week over week. The increases then felt more strongly in the remainder of 2026, with Q3 up over 12% and Q4 up almost 10% on the week. The frontier has seen more modest increases, with increasing prices of just around 3.4% on the week. And then further along the curve, we continue to see a more stable to slightly downward evolution. As I mentioned, one of the main drivers of the rebound in the market certainly being the weather conditions and the colder weather Europe has experienced. The impact of the colder weather has been that storage levels across Europe have been decreasing at a faster pace than previous years. And particularly over the past week, we've seen the deficit versus the previous year expand once again. Withdrawals over the course of January so far have at times been at the highest levels since at least 2012, very much showcasing the more adverse weather conditions and the more pressure that the rise in demand has had on storage levels. The storage deficit is now around 11%, and one of the bullish factors in the market as concerns have been raising regarding the state of gas storage levels in Europe at the end of this winter and what that will mean for injection demand ahead of the following winter. Total demand, as you can see here, rose very sharply through the first half of January on the back of those below average temperatures, while total supply has seen an only modest increase from the beginning of the year. Part of the difficulty in increasing the total gas supply into Europe is one, the fact that Norwegian gas flows are already at quite high levels and there's little additional room for further increases, with output in line with the past 5-year average and last year's levels. LNG standards are already at 5-year highs so far in January. In terms of LNG imports into Europe, we do see the share of global exports increasing slightly over the past week as total global LNG export capacity continues to increase year over year. One notable impact that is benefiting European consumers is the fact that Asian demand for LNG remains muted compared to previous years, limiting the price competition with Europe. Overall, investment funds, which had seen a record high level of short positions in the market going into the end of last year, has seen those positions start to move in the opposite direction, with an increase in the level of long positions and overall net positions moving closer towards an even split between long and short after a period of more short positions in the market. Coal. Coal prices over the past week have seen a slight increase of around 1 to 1.5 percentage points on the API 2 and API 4 index, while the Newcastle index for the frontier rose by 5%. Overall, in Europe, demand for coal remains quite muted for both industry and the power sector, which in turn has made the current level of ARA coal stocks more than adequate to meet ongoing demand. As a result, we are seeing more limited demand for new arrivals, putting downward pressure on European coal prices. On the other hand, we are seeing signs that coal imports from China are expected to increase in the year, adding additional upward pressure on Asian coal prices. EU and UK emission allowances. Moving then towards emission allowance prices, we see a further increase in the price level, with carbon pricing increasing by around 3% on the European side and 3.5 percentage points on the UK side. Overall, market expectations remain bullish as market participants expect tighter EU ETS market conditions as the Repower EU program, which had been front-loading carbon emissions over the past few years, has ended. As a result, we'll be seeing tighter supply and demand conditions moving forward. Additionally, the colder weather that we've been seeing through January has increased the share of fossil fuels out of the power mix, and as a result has increased the level of carbon emissions from the power sector, adding some additional support. Now, there's still some uncertainty regarding the economic outlook for Europe, and certainly the situation in Greenland is potentially weighing on future demand growth, but yet to be seen what the resolution of that will be. Overall, emissions from the power sector, as I mentioned, have been increasing over the past week, moving in line with the past 5-year average. Investment funds continue to remain bullish when it comes to carbon pricing, with the level of long positions continuing to reach new record highs in the market. Electricity. Moving then on to electricity prices. Electricity prices have seen a rebound in the price level, similar to what we've been seeing in the natural gas market as well. The increase is more pronounced in the shorter term, with the largest increase seen in the second quarter of the year, moving up almost 9% on the week. In terms of total demand, we see that sharp increase in demand through the first half of January as the below average temperatures led to an increase in demand, pushing up total European demand to the highest levels over the past 5 years, although over the last few days we've seen that come down to be more in line with the average. In terms of the supply mix, at the same time as demand has been surging across Europe, we've also seen a drop in French nuclear power output, adding more pressure on fossil fuels to cover the increase in total demand, and as a result increasing both the level of emissions but also the influence of rising gas prices on power prices. Renewable generation has come down over the past week, largely on the back of poor wind power generation, while fossil fuel generation has steadily been increasing. In terms of renewables, we see the drop in wind power generation over the past week, while looking at solar, for example, we do see solar output at the top of the range, although it remains limited due to the seasonality of solar power. Looking then at hydro reservoir generation, there we see output at above the past 5-year average. Looking at fossil gas generation, we see the record high levels of output near the top of the range over the past 5 years. On the other hand, even though we've seen an increase in fossil coal generation, total generation from coal-fired power plants remains at the bottom of the range over the past 5 years, highlighting the weaker demand for coal-fired power generation. Lastly, when we look at guarantees of origin here, we note the bearish price evolution across technologies and production years as European guarantees of origin prices edged lower on oversupply concerns, given the brighter and improved performance of renewables throughout last year and forecasted for this year as well. That covers this market presentation. Thank you for joining.